All right. Well, good afternoon. It's good to see all of you. I hope that you brought a pen and paper because we're going to be covering a lot of material. This book is the result of a lot of years thinking about this, of seeing the crisis back as I was finishing college and thinking about it and going to grad school in part motivated by trying to understand how it happened, how we think about the role of markets and government in the way that this played out. And so I wrote this book after having written and thought and studied the crisis for a long time, and I wrote it for educated citizens, for people who read the Wall Street Journal, and my hope was to present something that was very understandable about how the crisis played out, trying to take fairly complex financial terms and ideas and make it simpler, and then also to assess the explanations that we've had that have created public policy that we've seen impacting the country and the financial sector. So this book is written really for all of you, and what I'm going to do today is run through a lot of the main ideas, the main themes. My hope is that as I finish, you'll be able to walk away with a much better understanding of the crisis. So the book is just structured around three simple questions. The first part is what happened in the 2008 financial crisis. The second part is why did it happen, looking at alternative explanations. And the third part is what now? Now that we're 10 years later, what does this mean for us going forward? So the crisis was extremely significant on a number of levels, and there are some things on the slide up here that you can see. Trillions of dollars of wealth disappeared over the course of the crisis. Stock prices fell over 50%. Housing prices declined actually close to 30%. We had trillions of dollars of additional government loans and spending in a variety of ways. There was a sovereign debt crisis in Europe, which is not the direct point of this talk, but we can talk about in the Q&A if you're interested. And I think it also has contributed to some extent to greater income and wealth inequality, as we've seen foreclosures and shifting within the economy. Unemployment increased from under 5% to over 10%. There was also a huge growth in regulation and the discretion of regulators. So the Dodd-Frank Financial Reform Bill, the major act of Congress in response to the crisis, was about 2,300 pages long. And that didn't even specify all the rules. It was the rules about what rules needed to be made. By some estimates, almost half of all regulations that were created under the Obama administration stemmed out of Dodd-Frank and its reforms over his entire 8 years. So it's an incredibly complex, long reform, and it was a response to the conventional narrative about why the crisis happened and attempts to fix that. I think we've also seen political polarization, and the question, again, that informed me as I was thinking about this 10 years ago is this a black eye for free markets? Is finance something that markets and market discipline and the invisible hand of Adam Smith can't coordinate and occasionally runs off the rails? So how bad was the 2008 financial crisis? I'm going to show you a bunch of graphs here, again, just to illustrate things. Some of you have seen this before, some of you haven't, but to give you a sense of how bad things were, we can look at the decline in net worth among households and nonprofit organizations. You can see it peaks and it declines. The gray part represents the recession. Declines trillions of dollars, about $15 trillion. Of course, the rest of the story is that since then, it's taken off, and we can talk about why that has been later. Same thing for house prices. This is an indice of house prices across the country. You can see the rapid increase in housing prices in the early 2000s. It levels off, and then it crashes about 30%. That also has returned, and in fact, the house indices are higher now than they were at the peak before the crisis, which has, I think, a number of implications. Along with that, as housing prices fall, any of you who own houses know, equity falls. The amount of equity you have in your house, the value of the house versus the mortgage declines. And so we see a significant decline in equity, which is a huge amount of people's net worth. This is a graph of unemployment. If you look again all the way over towards the right, you can see a very, very steep increase in unemployment from under 5% to over 10%. That's the recession of the economy slowing down as a result of this crisis. And then it has since declined, but at a slightly slower rate than normal. This is a graph of labor force participation. And this is to say just how many people are in the labor force. And you can see it peaked in the early 2000s and was beginning to decline. And if you look at, again, that last gray line for the recession, there was actually a very significant decline. And even through the entire recovery, so 8 years following the crisis, the labor force participation continues to decline. And a lot of people attribute that to people dropping out of the labor force, and especially prime age male men dropping out of the labor force, which is historically unusual. In terms of GDP, you can see how there's this growth trajectory in GDP over time, and then it takes a dip during the recession. And what economists have commented on and worried about is normally you have dips like this during a recession, and then it recovers back to the trend line. But in fact, what we've seen is a parallel line at a lower level. And economists have talked about what is going on with this, why have we not recovered to the previous trend line. Some have written about a great stagnation and other sorts of issues in the economy. There's a massive increase in public debt. You can see that debt to GDP explodes, particularly over the crisis, and then a little bit following it with the massive stimulus plan in 2009. So we've got increasing government debt. This is a graph of the monetary base. The amount of liabilities of the Federal Reserve has also increased significantly, something about 5 times larger, from about $800 billion to reaching just over $4 trillion. Massive, unprecedented interventions by the Fed, and we can talk about some of the implications of that. So all of these graphs, I know it's a lot of information, but it's meant to highlight that something very significant happened across the markets, across all these different indicators that we should be worried about and we should think about. This, again, there's a lot of stuff on here. This is a timeline of some of the major events. I want to highlight 3 that are going to be really important to the story of how the crisis played out and how the government responded. And so the 3 I want to highlight, they're bolded here. The first is the failure of Bear Stearns in March of 2008. And the federal government, the Federal Reserve, and the Treasury helped broker a deal where Bear Stearns was taken over by J.P. Morgan instead of declaring bankruptcy. That, I'm going to argue, it was really significant for the actions of other investment banks and financial institutions for the rest of the summer. So after March, they took significant risks thinking that they had an implicit bailout or guarantee. If Bear Stearns got bailed out, it was the smallest investment bank, then surely the government wouldn't let other ones fail. Which leads to the next major event, which is Lehman Brothers, a much larger investment bank, fails in September of 2008 and is not bailed out. At that point in time, it was the largest bankruptcy in U.S. history, extremely complicated and also disorderly because they had not prepared for bankruptcy because they didn't expect to go bankrupt. And so the failure of Lehman Brothers was really, really problematic. And I'm going to talk later about just how bad that was and how that fits in the conventional wisdom narrative. So Bear Stearns failing in March, Lehman in September, and then the biggest sort of public policy response that we see is Congress passed what we call the bailout bill, the Troubled Asset Relief Bill, early October. And the idea is this was the bank bailout bill, that we're going to use huge amounts of money. Initially, it was between $700 and $800 billion to try to buy bad assets, recapitalize the banks. And TARP also, I think, plays a major part of the story of how the 2008 financial crisis happened, how it plays out. So I'm going to go into that in more depth later. But first, let's think about some other consequences of the crisis. So I think it's not hard to see that the crisis has at least contributed in some ways to the increasingly polarized political environment we find ourselves in. If you remember, Occupy Wall Street was a movement not far from here in response to the bailouts of these Wall Street banks instead of Main Street. But not long after that, you also have the Tea Party movement in response not so much to the financial crisis, but to the government's response to the financial crisis and concerns about government spending and favoritism and so forth. And so we have these increasing concerns about cronyism, globalization, a new elite, that the financial crisis and the responses to it have sort of revealed within the body politic. We have resurgent concerns about income and wealth inequality. That's when people really began talking about it again quite a bit when the crisis happened, and they haven't stopped, and it's a big part of our public discourse today. And then finally, there has been an increased skepticism of banks and of capitalism more generally, concerns that free markets and capitalism are not fair, that they don't benefit the poor, that they favor connected elites. And so we've seen, again, a huge shift in public discourse, I think, as a response to this crisis. So how did the crisis happen? There's obviously a lot to it. I'm going to give you, again, a simplified version. But basically, here's how I think we ought to think about it. The financial crisis stemmed initially from a housing bubble. Okay, people were buying lots of houses. Housing prices were being driven up dramatically. And then the interesting part is that these housing prices were being bought with loans, with mortgages. And the mortgages, instead of being held by banks the way they were, say, in the 60s and the 70s, where the banks would issue a loan to you, the home buyer, and you would pay them back over time, increasingly these mortgages were sold to other financial institutions, especially Fannie Mae and Freddie Mac, these large government-sponsored enterprises that were created to support the housing industry. And what happened is they securitized these mortgages. And what that meant is you would have these agencies, they would buy thousands of different mortgages from banks and mortgage origination companies all over the country. They would buy them, they would put them in a pool. Okay, so you have this pool of thousands of mortgages. People are making their monthly payments, principal and interest payments are going into this pool. And then what Fannie and Freddie and some investment banks would do is they would sell shares or claims to the revenue from this pool. And that's what a mortgage-backed security is. It's a security, it's a claim, it's a share to the funds that are going into this pool of mortgages. And they made it more complicated that where what they call tranched it, where some shares got paid first and then some shares got paid later. So they have these different levels. Some are riskier, some are safer. You have different trade-offs in terms of risk and reward. But the reason why this is significant is because these mortgage-backed securities were then sold throughout the world. They were sold to insurance funds, pension funds, sovereign wealth funds. What happened through securitization is that what was going on in the housing market was then spread throughout the financial system in the US and the rest of the world. And so the risk was spread around and the financial aspects were spread around throughout the system. The other thing you have going on is the role of banks in this process. So banks were generally very highly leveraged. That's often how finance works. Leverage is when you borrow large amounts of money on top of your initial equity or money that's invested in your institution. And when you have high levels of leverage, it means you can get really high returns if you do well, but it also can magnify your losses if things go badly. And so as the crisis unfolded, as the housing market crashed and people began defaulting, and this pool of mortgages, fewer and fewer of those mortgages were receiving payments month to month, these mortgage-backed securities and also collateralized debt obligations, which is basically a pool of mortgage-backed securities that you sell shares to, began declining in value, and this created huge problems for many large financial institutions because they were taking losses on their books, and the leverage that had allowed them to make huge profits and make a huge amount of money with relatively little equity, then turned around and made huge losses and caused lots of problems. Again, that we'll get into a little bit later. And so the housing bubble popping creates this stress in the financial institutions and financial markets, which led to less lending in the economy. So you might be wondering, well, what do banks have to do with employment and how the economy is doing? Well, the major mechanism by which banks affect the economy is through the loans that they issue for people who are starting businesses, who are buying houses, who are going to college, all the different things that people borrow money for. As the banks were suffering large losses, they cut off their lending because they were trying to conserve what money and capital they had. And we can talk about that more later as well. And then the final piece of this financial crisis that made it a true financial crisis is this idea of contagion. And that's as we look at large financial institutions, they were all interconnected in complex ways. And so as one financial institution, as one bank had trouble, that could create problems for other banks as they had different positions and exchanges. And so there was this worry about a domino effect and contagion that public policies were worried about and felt that they had to stymie. So again, we have this idea of leverage, which made banks fragile to losses. One other thing that I'll mention, besides what I've already talked about, securitization, is the way in which many of these large financial institutions were funded. So not only did they have a lot of debt, but a lot of the debt was very short term. That is to say, they would borrow money for a period of months or sometimes even weeks, billions of dollars, and then when the loan came due a week or two later, they would roll it over. They would renew the loan. They would pay some interest and renew it. And so they would be continually borrowing money on a short-term basis because it was cheaper to borrow at that rate, and people felt more comfortable lending money at shorter-term rates because it's unlikely that the firm you're investing in is going to go bankrupt in the next week. So the idea is that short-term funding is both safer for the lender and it's cheaper for the borrower. Investment banks were heavily involved in this market. The problem is it's built on being able to roll over that debt. And as confidence deteriorated, as people began to worry about the quality of mortgage-backed securities and the strength of banks' balance sheets, all of a sudden large lenders in this market that we call it the commercial paper market began to withdraw billions and billions of dollars. And so it left banks like Lehman Brothers or Bear Stearns on the hook, where they had this $1 billion coming due in a couple weeks, and they couldn't renew it, and so they had to sell huge amounts of assets. And as they had to dump their assets on the market, that drove down the price of those assets, which then contributed to problems with mark-to-market accounting that I'll talk about later. And so we have this sort of cascading effect here where we get this downward spiral of problems in the housing market, causing asset values to decline, causing a deterioration in confidence, which then makes it more difficult for these leverage banks to raise money. So then they have to sell assets, which further push down the prices of those assets, which then, again, contributes to declining confidence. It's a fairly bleak story, and then this story is going to drive a lot of the panic among policymakers in the fall of 2008. Okay, went through that very quickly, but there's much more to be said. But let's talk about not so much what happened, but why it happened, okay? How do we get to this point of trillions of dollars of mortgages securitized and bought and sold throughout the financial industry with these highly leveraged financial institutions that have short-term funding? There are kind of four major conventional wisdom explanations that I discuss in the book that are kind of out there in the public discourse. The first story, the biggest story, is that of deregulation. All right, the story goes, there are different versions of it. One story is that in the late 1990s, early 2000s, we had significant banking deregulation, which allowed increasing leverage, is one story that allowed these banks to take more risk. Some go back even further to the 1980s under Reagan, when we had some other deregulation of banking back then. There's this idea that the mortgage market was not regulated very well, so you have all these predatory loans and all these bad mortgages that are issued because regulators were not doing their job. A lot of people blame this on so-called market fundamentalism or free market fundamentalism within the Bush administration, and regulators thinking that the market will regulate itself, and so they don't need to enforce various kinds of rules. So this story, again, probably the most prominent one is it was deregulation that sort of unleashed the banks and capitalism and greed to create the financial crisis. The problem is that it's just basically not true, okay? So there were deregulations that happened, but it's not true that the financial sector was not heavily regulated, okay? It's the most heavily regulated sector besides perhaps healthcare. It's also not true that the major problems that we see in terms of the risks that banks were taking and the deterioration in mortgage quality were driven by deregulation. In fact, and I'll talk about some of this later, we can find several specific regulations that pushed financial institutions, mortgage lenders, and individuals into making riskier bets with the mortgage that they issued and the assets that they bought in financial markets. So we can come back to that later. The second story, which again kind of builds out of the deregulation, is this idea of greed and leverage on Wall Street. So if you've seen The Big Short or if you've seen other kinds of movies about the crisis, there's this idea that Wall Street went crazy, right? That traders were unrestrained, they took huge risks, they were completely irresponsible in everything that they did. And the issue with this story is it fails to address, well, why did they start going crazy in the 2000s and not in the 1990s or the 1980s? Why did people somehow magically become more greedy than they were before? And so if we want to really understand analytically what happened, we need some kind of explanation for a change in behavior as opposed to, well, people were just greedier. That by itself is not a good explanation. It doesn't explain what we see in terms of the difference in the 2000s versus earlier. And then the third part of the story, combining these two, is that people will say, well, the reason that the greed changed and was unrestrained is because of the deregulation in the 90s and early 2000s that allowed Wall Street and bankers were on a shorter leash with regulators. We gave them more leash, and they went off and took huge amounts of risk. And so there's the idea of moral hazard, that Wall Street took huge risks because regulations were curtailed, because they had implicit backing by the government in the form of bailouts. We'll talk about that. Again, I think it misunderstands the whole regulatory story of the 90s and the 2000s. And then the fourth story is that of irrational exuberance. And it's this old story. It goes back to John Maynard Keynes in the 1930s, and you can find instances of it even earlier. But there's this idea that there's a certain amount of irrationality in the market, that people, and investors in particular, are driven by animal spirits. That is to say, that we think about investors perhaps as being rational and calculating, but there's this idea of, well, actually, they get caught up in the times. They get caught up in lots of people are making money buying houses. Lots of people are making money securitizing mortgages. It's the thing to do, the thing to be in. And so the story that Keynes tells and that Robert Shiller, a Nobel Prize winner, today tells is that the housing bubble was driven not so much by government policy or regulation, but by this sort of animal spirit optimism that was reinforced in the media and was reinforced in informal ways and expectations. And again, we'll talk about why that, I think, is not sufficient to explain how did those things start and how do we get to the point that we're at. So in contrast to the conventional wisdom, there are a number of dissenting views that I present. And you can kind of think of all of these dissenting views as falling roughly under the bucket of misregulation. There are four kind of broad culprits that I want to highlight here. So culprit number one, and this has been probably the most prominent in the media, is the Federal Reserve. Okay, the Federal Reserve System, the central bank of the United States, is responsible for setting and affecting interest rates, particularly short-term interest rates. And the Federal Reserve, in the early 2000s, in response to the terrorist attacks and the dot-com bubble and the recession that was happening at the turn of the century, lowered short-term interest rates significantly, which it often would do in response to crises. But then it kept those interest rates low for a long period of time, longer than most sort of economists or policy analysts thought would be good. And in keeping those interest rates low, it fueled, in part, the housing bubble, because the largest cost to buying a house used for most people is the mortgage, the borrowing the money, and the cost of the borrowing has to do with the interest you have to pay on it. And so if interest rates are really low, you reduce the cost of people borrowing. They can borrow more money, they can buy larger houses, and that drives demand for housing. So people have pointed to the Federal Reserve and said their low interest rate policies fueled the housing bubble, which then built on with everything else. Culprit number two is the role that Congress, the Department of Housing and Urban Development, and the Community Reinvestment Act played in the 90s. And this, I think, is where I've kind of settled as one of the most important issues. Peter Wallison has written about this. He was on the study that Congress commissioned about the crisis. And basically what happened is there was a concerted effort in the early 90s through the early 2000s to undermine lending standards. Okay, and you can find documents in this. You can find this in documents from congressional officials. You can find this in documents from HUD in terms of its studies. They're complaining in the early 90s that the market, left to itself, will keep underwriting standards too high. They'll have too high of standards for mortgage lending. You might say, well, what does that mean, too high standards? The worry is that, well, with these high standards, poorer people are not going to have access to the market. So what we need to do is we need to intentionally push banks to lower their underwriting standards to make lending and mortgage credit more widely available. So there was a concerted effort over more than a decade, and we might talk about this later, in terms of underwriting standards declining from the traditional 20% down payment. Your mortgage payments had to be no more than a third of your pre-tax income. By the time the housing bubble is in full swing, you have people buying homes for 10% down, for 3% down, in some cases for nothing down. You have people whose monthly payments are 40%, 50% of their pre-tax income. Basically, in every category you can imagine, you can find underwriting standards deteriorating from the late 90s through the 2000s until the housing bubble pops. Culprit number three, which is also important and less known, is financial regulators were involved in this. And in particular, there are a number of regulations that encouraged commercial banks to jump on the mortgage-backed security bandwagon. All right, that there were regulations that's called the recourse rule in 2001. There were also international capital requirements that basically encourage banks by saying they could hold less capital against some types of assets that they viewed as less risky versus other assets that were more risky. And so you see, after this rule is passed in the U.S., the recourse rule in 2001, that commercial banks across the board begin to increase how many mortgage-backed securities they buy, which then creates huge problems in 2008 as those mortgage-backed securities built on the housing market that's collapsing begin to lose value, and they have to adjust and take losses on some of those holdings. And then the fourth culprit here is the bailouts and the ad hoc responses. And this is where I spend several chapters of the book kind of diving into where the rubber meets the road on how the impact conventional wisdom has had both in the response to the crisis and after the crisis. And so for those of you who are at all familiar with the crisis, know that in the fall of 2008, when Lehman Brothers fails, Hank Paulson, who's the Secretary of the Treasury, and Ben Bernanke, who's the chairman of the Fed, and Tim Geithner, who's the head of the New York Fed, think the world is going to end. They go to Congress to ask for the bailout money, and they more or less say that the Great Depression is coming and Western civilization will end. Financial system will collapse entirely if we don't have this bailout money. And so they see Lehman as being this huge problem and TARP being one of the primary ways to fix it. All right, I'm going to run through this very, very quickly because I want to make sure we have time for conversation here. But here are just some things that I bring up that suggest that, this is the main point, that suggests that actually Lehman's failure was not the main problem. It looks on a number of levels like the bailout itself was the problem. And it was the problem for three reasons. So first, not just the bailout, there were lots of other inventions as well, but what the government was doing and intervening throughout 2008 is it was creating legal and regulatory uncertainty. All right, financial institutions didn't know how they were going to be treated. They thought they were going to be bailed out, and then Lehman failed, so they thought maybe they weren't going to be bailed out, but then AIG was bailed out. And so we have this story of the federal government kind of bailing out some firms and not others, kind of switching back and forth, which is not good for market confidence. And they created and encouraged panic among market participants, saying the world's going to end if we don't get $800 billion to recapitalize the banks. That's not a good message to send to investors. The way in which they administered TARP created huge problems, which we might talk about later. And then at the end of the day, what all of this had to do, and the legacy that this created, is it made markets less dynamic, all right, by subverting profit and loss signals. Normally, firms that do well gain profits and they grow and they become more efficient over time. Firms that do badly lose money and they shrink. By bailing out failing financial firms and by putting money into the system, they're preventing this market mechanism, and we have a legacy of slow growth. That this recession, coming out of the recession and this crisis, we had the slowest recovery in U.S. history. So I'm going to skip over a few things here. I want to run through, here's an example of just a few government interventions. I want to run forward to some data to think about. So one thing that I point out that as far as I know I haven't seen detailed elsewhere is that the stock market was far more volatile after TARP than before. So again, remember, TARP is the bailout program to try to calm markets, bail out the banks, fix the crisis. Yet if you look at the 10 largest one-day declines in stock prices, 8 of them happen after TARP, even though it's just October, November, December. And in fact, the 2 others that were before TARP, one of them was when Lehman fails, all right, biggest bankruptcy in U.S. history. That was a bad day. But also the day they first voted on TARP and failed to pass it. And so even though it happened before TARP, it was strongly TARP related. So you could even say that 9 of the 10 largest one-day stock declines happened after the bailout program as opposed to before it. And so you can also look at, this might be a little bit harder to see, if you compare how much the stock market declined between Lehman and TARP versus the 3 weeks after, twice as much. If you look at the 6-month period before TARP and after TARP to the trough, about twice as much. In the single week following the passage of the bailout bill, stock markets declined about 18% in 1 week after the bailout was passed. Okay, all of this I think is very suggestive that the bailout did not work as people thought it would. So what now? I'm going to finish up very quickly here. What are we left with? We're left with an incredibly regulated financial industry, one that we think the problem was because of a lack of regulation as opposed to misregulation. We're left with a less dynamic financial system, a less dynamic economy, and we're left with a legacy of slower growth. That, in fact, the world probably would have been a better place if we had intervened less in 2008. And one last thing I'll leave you with, and a suggestion I make in my book, is people will say, well, yes, maybe the bailouts weren't great, but if the world is going to end, or if the recession would have been so much worse if we haven't bailed them out. All right, and I say this, all right, I'll grant that if you give me higher growth. If you give me a higher growth rate coming out of the crisis because we don't mess with the market, we don't make it less efficient, we don't bail out inefficient firms, I'll grant that it could have been worse. What could have happened? All right, just as the last slide to show you this, our average real GDP growth per year coming out of the crisis was about 2%. In contrast, the previous 10 recessions, the average growth after the recession was about 4.3%, more than twice as much annual growth. Our actual GDP decline during the recession after the financial crisis was 4%. So what if you gave me 0.5 percentage of higher growth, all right, for the 10 years following the crisis? If you've given me 0.5% higher growth, the economy could have declined 175% more, 7.35%, and we still would have been at the same place in 2017. If you give me 1% more growth, if the economy had been 1% more efficient in terms of its GDP growth, the GDP could have declined more than 200% than it did. And if we had had the historical recovery rate coming out of the crisis, GDP could have declined 4 times as much, and we would still be where we were with higher growth 10 years later. So with that, I know there's a lot, but I want to have a conversation here with Mr. Bahnsen, and we're going to go deeper into some of the issues that, from his perspective, are overlooked in the economy and overlooked in public discourse. And so we'll turn to that now. Thank you.
How are y'all doing today? Okay, this is pretty fun stuff, don't you think? This has got everyone pumped up. I want to start with something you said near the end, and then I kind of want to work backwards to a few things that came up throughout. The point you made regarding the way the stock market behaved after TARP passed is empirically undeniable. But there's a factoid you didn't share that I'm going to suggest is more important and is perhaps disputive of your contention, or at least requires maybe a little interaction. At the time TARP passed, a lot of the bonds of these major banks were trading at 60 to 70 cents on the dollar. And I use that as only as an example of the credit markets were unbelievably distressed. The credit markets trump the size of our stock market many times over, as you know. TARP passes, stock market continues to be very volatile. After all, why wouldn't it be? We were in a recession. In fact, ended up being in a very, very deep recession. However, the credit markets did restore. Those bonds were trading at 100 cents on the dollar within a few weeks. What would you say to those that say TARP may have been good, may have been bad, but it wasn't ever supposed to be about the stock market? It was supposed to be about the credit market, and it did accomplish what it set out to do there.
Yeah, no, that's a great question. I think that there are a couple responses. One is to think about, so I've talked with John Allison about this, and one of the things he points out is the way that TARP kind of worked in reverse. So the idea of TARP was to restore confidence. And in particular, certain banks had very distressed bonds, but some banks were doing well. So like, you know, Wells Fargo was doing well, and BB&T and some other banks were doing well. And the way that TARP worked is, if you've seen Too Big to Fail, they document this, but basically they called all of the CEOs of the 9 or 10 largest banks by assets to Washington, D.C. for a meeting. And then they gave them a piece of paper saying, here's how much your bank is going to take from TARP. And several of the CEOs said, well, we don't really need capital, we're fine. And Paulson said, no, you need to take the TARP money, because if you don't take it, the markets will know which are the distressed banks and which are not distressed. So we have to have all the banks take it so that people don't run on Citibank in particular and others. And what John Allison has said, and Kovacevic has corroborated, is that a lot of people in the market already knew which one the bad banks were. And then they had seen deposits were moving away from Citibank. They were moving away from Bank of America and so forth to some safer institutions. And that flow of funds stopped immediately. And so even if it provided, so TARP was certainly good for Citibank. It was certainly good for some of the most distressed banks.
For the bonds of Citibank.
Correct. Mm-hmm. Well, and for Citibank itself in terms of keeping it afloat. Mm-hmm. But it also, it stopped the flow of funds that was happening from the banks that were worse managed and having more trouble to banks that were better managed.
So you made reference to the idea that Bear Stearns getting their sort of quasi bailout. In their case, no Treasury Department money, no taxpayer money, no act of Congress took place.
Correct.
But it was coordinated, and then Federal Reserve did back liabilities that enabled J.P. Morgan to take over Bear Stearns in March. And so I guess I want to push back a little, or I'm curious about your take, that the idea that it enabled Lehman, let's say, to not go address their capital deficiency because they saw the kind of bailout take place for Bear. But Bear's equity was wiped out. Now, it wasn't literally wiped out. They allowed the deal to go at $2 a share, but it bid at $130. So they were basically people that had a lot of Bear stock ended up with a 99% loss. That's not much of a bailout. I've always thought that some of these guys were not necessarily trading off of moral hazard as much as idiocy, that they were super dumb people. And I'm wondering if there's a combination of the two, that Bear getting bailed out should have been a signal. The whole thing people don't talk about, Dick Fuld at Lehman Brothers, never sold a single share of stock. Is there a possibility that this issue about the credits that were bailed out, the depositors that were bailed out, and the stock prices, that we as a society in a more competent conversation have not differentiated between the two?
Yeah, no, that's a great question. So there are a couple of things I want to say in response to that. So one thing I didn't mention about the greed story and that Wall Street is sort of fleecing everyone is what it fails to recognize is that a lot of people on Wall Street were taken completely by surprise when the crisis came, and they were caught with bad positions, And the story, with Bear Stearns as well, is that Bear Stearns launched these two hedge funds in 2007 to trade mortgage-backed securities, and then they had to shut them down within months because they lost money. And there was a big lawsuit of you're just trying to defraud your customers. And at the end of this lawsuit, basically the outcome from all the depositions and so forth, where it was fairly obvious the two guys running the hedge funds had no idea what they were doing. They had no idea, they didn't see it coming. They were completely ignorant about what was happening.
And the biggest investor in those hedge funds was Bear Stearns.
Ended up being Bear Stearns. That's right. So again, if banks had really seen this coming, if Wall Street had known exactly what was going to happen, a lot of them would have hedged more. But to get to your specific question about Lehman, so here's how I think about how do we see Lehman's behavior besides some internal anecdotes about how they were trading and thinking within the firm. We know, the way I think about it is that if you're right, Bear Stearns in terms of the quasi bailout, their share price was not very high in terms of what they ended up getting. But it kind of sets a floor, if you will, when Lehman is approached in terms of by other firms thinking about taking it over. If they're going to offer less than $10 a share, $12 a share to take them over, they have a good position to say, well, no, I think I can probably get better than that with some kind of government assistance or aid or some other broker deal. And we know that they turned down at least one offer over the summer where they thought the price was too low to be taken over. And that's where I see the moral hazard really playing out. So certainly there was ignorance and so forth, but I think it kind of, the bailout of Bear Stearns set kind of an implicit floor price that they were willing to accept in terms of either new capital coming into the firm or being acquired altogether.
You mentioned the significant regulatory push for there to be a deterioration of underwriting standards for the purpose of achieving a social good. That there ought to be greater lending to folks, and that was numerically regulated by pushing for lower credit quality, less down payment. Do you single out HUD as the chief culprit in that, or is there another regulatory body, another governmental body? And while we're on the subject of HUD, do you want to tell our friends here who was in charge of HUD at that time? Or do you want me to tell you?
No, I'll let you.
Well, I'll give you a hint. He's currently the governor of the great state of New York. A lot
There
of
you
people
go.
forget that. He was a very young man, but Andrew Cuomo single-handedly drove that expansion at HUD in the Clinton administration in the 90s. But I guess I'm wondering, is HUD who's to blame there? Is there a milieu of governmental bodies? How would you address that?
Yeah, no, it's a good question. So Congress is involved in setting the standards for some of this regulatory push. And Fannie and Freddie, who have been kind of the background here, are kind of the mechanism by which HUD is able to promote a lot of this. So Fannie and Freddie, they're the major buyers of mortgages, packagers of mortgages. And a lot of how the Community Reinvestment Act was pushed and these regulations were in requiring Fannie and Freddie to buy an increasing number of low-quality mortgages. And the way the mortgage market develops is complicated in the sense of, they were pushing particularly what we call subprime mortgage lending. And yet the crisis wasn't solely a subprime mortgage crisis, as you know. It was also people taking out second loans, people of middle income or lower upper income simply walking away from houses. But the effect of pushing subprime and pushing on all of these lending standards affected the whole lending market, affected the whole landscape of the mortgage market. And so one of the ironies is that a lot of these mortgages that weren't quite subprime but weren't the traditional prime of 20% down, low interest to yearly payments, were called Alt-A loans, alternative to agency. Agencies are Fannie and Freddie. These were loans that Fannie and Freddie would not have been allowed to buy in the 70s, the 80s, the 90s, and yet Fannie and Freddie in the early 2000s were the largest holders of these loans, these alternative to agency loans that now they were being encouraged and to hold, required to hold.
Yeah. Well, it's a great point. One of the things at the end of the talk that seems to be a real driver, and obviously I've read the book, and essentially your thesis is that the aftermath to the crisis and the errors that may have been committed from a policy standpoint there are largely driven around the reaction in September of 08. Let's call it kind of ground zero of the crisis. And you highlighted in your talk today the Lehman bankruptcy. But I get the impression that you don't necessarily believe Secretary Paulson or then Chairman Bernanke that things were as bad as they said, that they went to Congress. Now, one could believe that some of the policy prescriptions to what happened were the wrong prescriptions, but it's somewhat out of consensus to argue that things were not necessarily as bad.
Yeah.
And so I have my own view on it, but I kind of want to see if you wouldn't mind unpacking that a little.
Yeah, no, that's a great question. I think at the end of the day, I'm somewhat uncertain on how strong of a position to take on this. So one of the things I talk about in the book is I talk about the easy case and then the harder case and the hardest case to make. So, to argue that bailing or the quasi bailout of Bear Stearns was a bad idea is fairly easy to make. Like at that point, markets weren't under distress. It would have been relatively easy to let them go. They were smaller, would have imposed a huge amount of market discipline. I don't think that's as hard of a case to make. Obviously, some people would disagree. That seems like the easy case. The harder case would be saying, yeah, we should let Lehman fail. The hardest case would be saying, actually, we should let them all fail. So there was a significant amount of financial distress going on. Markets were obviously having trouble. The way in which it would have played out, it's very hard to say in terms of there is no consensus in terms of if we hadn't bailed out AIG, what would have happened if we hadn't guaranteed money market mutual funds, what would have happened. I do think that it was distress. One of the points I didn't have a chance to bring up here, but that Peter Wallison makes about why, what I want to emphasize particularly is that TARP just doesn't seem to have been the solution people thought it was. And another thing that he says that Wallison points out is that, TARP was passed on October 3rd, but none of the banks got any money until October 28th. So like if there were banks that were on the brink of failing on October 3rd, they didn't get any government money until the 28th. Now, again, the confidence piece is an important one, talking about the bonds, and we can go into that more in terms of maybe their financing was eased somewhat. But it's as I've thought about it and looked at it, it's not clear to me that the whole world was falling apart. As one person pointed out, and if you've read Paulson's memoir on this, Hank Paulson was from Wall Street. He was the CEO of Goldman Sachs, and his memoir talks about how he's on the phone all the time trying to figure out what's going on, and he's talking to the CEOs of firms on Wall Street all the time. John Allison told me he even attempted to get an interview or to go talk with Paulson before this crisis, and Paulson just wasn't interested because he was a regional bank. He wasn't part of one of the big Wall Street firms. And so I think part of what we have here, particularly with Paulson Geithner and Bernanke is I think we have an example of myopia. I think that they were intensely focused on some particularly large firms that were in particularly bad situations. And certainly there was distress across markets, but I'm not sure it was as catastrophic as they imagined it was going to be.
Okay. The labor participation force number, you talk about some of the different aspects since financial crisis that have continued to stay rather distressed. And I'm wondering if you view that particular metric as a byproduct of the financial crisis, or do you see it as having other economic causation, or do you see it as having non-economic causation, something more in the cultural and social realm?
Yeah, all of the above. So I think one thing I would say is the trend, the financial crisis did not start this trend. Okay, and if you look at the graph, the labor force participation begins declining in the early 2000s. So the financial crisis is not the primary cause. However, what I would argue, what I do argue, is that the financial crisis accelerated the trend we were already seeing. Because I think the biggest driver behind this, and we can maybe talk about this later, is disabilities and disabilities, unemployment, the ability to receive payments even if you're not working. And so as people lose their jobs, if they move on to disabilities, they never go back. And so the reason I bring that point up is a kind of twofold reason. One is I think the financial crisis accelerated this trend in terms of people leaving the labor force. But two, it also suggests that the economic recovery, particularly with unemployment going down, was not all about the people who are unemployed going back to work. In fact, many of them were leaving the labor force entirely. And so the reason we think about labor force participation and not just the unemployment rate is because people who aren't looking for work don't count as unemployed. So if we think about unemployment goes up, people lost their jobs, unemployment goes down, they get their jobs back. But in fact, unemployment can go down if they stop looking for work entirely, and that's where labor force participation comes into play.
Let me wrap up my last question in our discussion with a kind of faith orientation to the subject, and then we'll invite for some questions from the audience. You're critical, as I am, of excessive regulation, or critical of those who are critical of deregulation.
Right.
Roundabout way of saying the same thing, I suppose. And you're identifying as an economist some of the elements in which government policy and maybe misguided initiatives, the distorted price discovery, hurt the overall economy. However, I wonder, from a Christian standpoint, do we view greater home ownership as a good that ought to be pursued at all from the public policy front? What would be your approach as an economist and man of faith to those that worry about the inability of folks to obtain necessary access to the home market, things of that nature? There's a lot that went wrong. What would you want to see that would make it more right?
Yeah, I mean, I think the biggest thing that we would want to see is less distortion of markets. I mean, I think, even if we think about what's going on today with high rent prices and high housing prices all over the country, I don't see that as some sort of, the market is running out of control. I see, and we could look at different examples of, there's all kinds of distortions and restrictions in these in city markets, different cities and housing. And so I think that the best policy for the poor in particular is to remove distortions and barriers as opposed to trying to subsidize things. Because the problem, I mean, and this is what you learn in economics 101, the problem is the law of unintended consequences. When you try to give out mortgages to lower income folks by subsidizing it, well, it sounds nice on the surface, it creates unintended consequences and often doesn't actually help them because as things change, they might not be able to afford the house that they thought they were able to afford. And you have, the regulations, the risk-weighted capital idea I mentioned briefly. The idea is good of trying to reduce risk, but it creates systemic problems. It creates unintended consequences. So I think the best approach we can take is encouraging people to engage in productive activity and improving themselves and to find communities where they can be a part of and be productive, and removing the obstacles to employment, the obstacles to building houses, to building low-cost apartments. Very few people really realize how much of what we see in the housing market in particular is really artificial. That is to say, it hasn't been true historically that houses have always cost as much as they do. It hasn't been true that rents have had to be as high as they've been recently. So that's where I focus, and that's where I talk about why I push deregulations. A lot of people don't realize how many regulations and subsidies have actually created the problems that they want to address.
Yeah. Okay, I'll open it up for questions from the audience.
You can come up to the microphone up here. You can form a line up here to ask a question. Thank you. We're going to use this mic. What he's going to do.
Oh.
Hi, thank you for the talk today. I just had a question. I was wondering, without the bailout, at the time the banks were became a lot more risk averse to lending, and without the bailout, wouldn't this affect their lending to small businesses, especially those that were not yet profitable, and with the possible bankruptcy of those businesses, wouldn't that lead to a chain effect that could further send the economy into a downward spiral?
Yeah, great question. So that certainly was a concern. That was certainly a concern, and it was also a huge point of controversy. I mean, and you heard this over and over and over again. We need to bail out the banks so they keep lending to firms throughout the economy. And the controversies, it didn't seem like they were, right? That the banks, would receive TARP money or they'd receive lending from the Fed, and yet lending declined anyway. And so it is an important issue. It was part of the argument. It was part of the controversy that banks weren't doing this. In terms of what would it have looked like without
I would add, by the way, also in the monetary policy front, there was the argument that we needed these very aggressive forms of rate reduction and quantitative easing also to stimulate lending. So you had both the TARP fiscal side and the monetary, both driven by that same objective.
Yeah.
Yeah.
And yet we still saw, and I didn't actually have this graph, but we still see lending decline. So the kind of the question is always difficult to do counterfactuals or hypotheticals. You never really know. But what we do see is that the bailout and the fiscal policy, the monetary policy, with that goal in mind, at least doesn't appear to have been very successful in terms of there doesn't seem to have been much of a change in the decline in lending. Could it have been worse? It's certainly possible. But what I try to bring up in my book at different points is that if you look at government intervention on the whole, throughout the whole period, going back to Bear Stearns, maybe even a little bit before, all the way through, if you add all of that up, if you were to remove all of that, we would have been operating, I think, in a really different market. And so would it have been worse? Possibly, but if we'd had higher growth and a more dynamic economy and a more dynamic recovery, I think it would have been better. Because part of what has made the financial crisis so negative in people's minds is the recovery was slow. We talked about the jobless recovery, talked about the slow growth. And I think much of that, not all of it necessarily, but much of that is a legacy of the way in which they responded to the crisis at the time, as well as how they followed up with it with legislation. Yeah, thank you.
Thank you.
Anybody else?
Question. Dr. Tubbs or Fritz, both. Go ahead. Maybe we'll take both questions and then address them.
So there's been a lot of discussion recently about the student debt crisis, and there seems to be this sort of pop-level consensus that is going to cause the next Great Recession that we saw in 2008. So is that does that trend sort of follow, or is there something else that might prevent that, or how do they interact?
Good question. Let's take Dr. Tubbs' question too, and we'll address both of them.
So could you comment, Paul, on other housing bubbles, say in the last 30, 40 years, and what you would identify as a principal factor behind other housing bubbles before the Great Recession?
Great. So let's take the second question first. There have been housing bubbles in the past, but not a lot of them, actually. It's kind of surprising that you have to go back a long way to find a housing bubble of this proportion. So you do have housing bubbles in local markets. What's kind of unusual is this sort of national housing bubble. But at the end of the day, it almost always comes back to the cost of borrowing. It's a demand. It's usually, supply matters, but it's kind of a demand for the bubble to form as opposed to sort of normal market forces. There tends to be a huge spike in demand. So whether that's people returning from war or lowering interest rates, That's where I put a lot of the weight. In this recent housing bubble and in past ones, it's often that, although it can be a combination of things, but it's usually being easier to borrow to buy the house, I think, drives that. I mean, do you agree? Do you think anything else?
I
to
think
that?
the savings and loan crisis in early 90s is the maybe closest one outside of the Great Depression, because you're right. Other than that, there's been regional, usually driven by a local event, a company leaving a local market, things like that. On a national basis, savings and loan, and I think that one of the reasons I hesitated about 2008 is I don't believe that the housing bubble burst because rates went higher. I believe that it partially formed with rates going lower, but ultimately I think that the supply-demand aspects were so out of balance, that they were so distorted from reality that bubbles have to burst.
Yep. And then on the
Student loan
part, it's a really good question. I think there are some similarities, but there are a lot of differences too. So student loans are securitized. What would be concerning is we would have to think about what kind of a reason could there be, or what kind of event could happen that would lead to a huge spike in students defaulting on their debt. So we would need to think about what could happen. So if we had like some kind of major debt forgiveness policy created that led to 20% of that market disappearing, that would have significant impacts on the economy. That being said, it's the student debt is different in the sense that it's not tied to a real asset like a house and the equity that people have in houses, and also you're not going to get kind of the cascading real effects that the declining housing market had on the economy as well. Because not only do you have falling housing prices feed into the financial crisis, but you also have rising unemployment in construction industries, and it has all these other impacts with people who are working in these industries. So, the student debt bubble, if you will, could cause problems if there was some major shift and a lot of it defaulted, but I don't see it as being sort of structurally connected to the rest of the economy in the same way that mortgages were securitized and spread throughout the economy.
I think it's worth adding that the student loan debt is about 89% held on the government's balance sheet.
Yeah.
And so that's the categorical difference. I mean, the government doesn't want to take $1 trillion loss, but it isn't sitting on the bank's balance sheets that then would
Right.
lead to their insolvency and the cascading effect. We're at, by the way, 18% default on national student loan debt right now.
All right. Well, thank you.
That's it? Well done.
No, they were good.